The key to analysis and investment planning and portfolio allocation is to see what's coming. Some of the greatest fortunes in history have been made in the face of some of the greatest financial catastrophes in history. We all know about the Weimar hyperinflation, 1922, 1923. There was one guy, his name was Hugo Stinnes, who saw it coming. He went out and borrowed massive amounts of Reichsmarks. That was the currency at the time. He bought hard assets. He bought shipping lines, railroad lines, coal mines, steel factories, steel mills, etc. When the hyperinflation hit, he actually paid back his debt. The money was worthless. They were sweeping it down the sewers. But he said, okay, here's your Reichsmarks back. It cost him nothing. He kept all the assets, became the richest man in Germany. His nickname was Inflationskönig, which means the inflation king. Joseph P. Kennedy in the United States saw the crash of 1929 coming after making a lot of money on the bull market. He shorted everything and made a fortune in the 1929 stock market crash and became one of the richest men in the United States, and that family fortune still persists 5 generations later. So you can make a lot of money in a crash. You can make a lot of money in hyperinflation. You just have to see it coming and plan accordingly. My kind of recommended portfolio, the key is diversification. And when you say that, people roll their eyes and go, oh yeah, diversification, we know that, of course, but people don't really understand what diversification is. I run into people all the time and they say, Jim, I'm highly diversified. I've got 50 stocks in 10 different sectors, semiconductors, consumer non-durables, minerals and mining, etc. I'm fully diversified. I say, no, you're not. You may have 50 stocks, but you have one asset class, stocks. And they're highly correlated. They're less correlated when it doesn't matter, but they're highly correlated when it does matter. When markets are collapsing, they all go down at once, or maybe there's one stand up, but they pretty much all go down at once. You're not diversified at all. So what does real diversification look like? And what does a model portfolio look like for the world I'm describing? Well, you can have some stocks, that's fine. I'm not saying get out of all stocks, but be selective. Think of natural resources. Think of the oil majors. We didn't even talk about the Green News scam, as I call it, but all this climate alarmism, it's nonsense. I've studied the science. I know how to build the models. I mean, these United Nations models, they don't even backtest. I mean, they build a model, and if you take known data from prior decades and put it in the model, it doesn't get the right result. So if you can't backtest, how do you forecast? Well, the answer is you can. It's junk, it's garbage, but there's a whole ideology around that. Don't have to spend too much time on that. With that in mind, oil and natural gas are great sources of energy, highly efficient, going to be around for the foreseeable future. To the extent that oil companies have been beaten down, a company like BP or Total or ExxonMobil or Chevron, Marathon, etc., those can be your stocks or some of your stock components. So have some stocks, but that's a good sector to look at. Notes, government, high quality government notes, Australian government bonds, U.S. Treasury securities are going to do extremely well. Why? Because interest rates are going to come down. Those higher yields you're getting today, you'll be able to keep those and you'll have capital gains. So that's a good slice. Cash should be a big piece, maybe as much as 30%. Again, people say, Jim, why would I want cash? My bank's only paying, 1/4, 1/2, or 1% or whatever. It's dead money. Well, it's not. First of all, if deflation kicks in, which is a possibility, cash could be your best performing asset. It doesn't go up in nominal terms, but it goes up in real terms. Remember, it's the opposite of inflation. Inflation, your money is worth less, and deflation, your money is worth more. So cash will serve you well in deflation, but more to the point, it gives you optionality. I'm not saying have the cash forever, but if you have the cash and other things are collapsing, you can go shopping in the wreckage. So cash is a really big role to play. Real estate, I definitely recommend it. A speculative bubble may cool off, and I'm not big on commercial real estate because there are other problems associated with that, with the whole work from home movement and doing things on Zoom or whatever. Residential real estate, multifamily housing, income producing real estate, farmland, any kind of real estate that will last, not necessarily using too much leverage, and income producing will do very well. It's a real asset and it will serve you well. Gold and silver for a slice, I recommend 10%. Natural resources, water, agricultural assets. You see a lot of billionaires buying up a lot of farmland. There's a reason for that. They see what I'm describing. So my model portfolio would have, kind of in 10 or 15% slices of stocks, high quality U.S. government notes, cash, real estate, mostly residential, multifamily, farmland, gold and silver, and natural resources. That's robust. That's diversified. That will protect you against inflation with the gold. It'll protect you against deflation with the notes and the cash, but it has upside because you've got some stocks. That will serve you well in all states of the world. There's something else going on in the space, which I don't want to spend a lot of time on, but just briefly, central bank digital currencies, CBDCs. These are not cryptocurrencies. It's not a blockchain. It's not decentralized. These are issued by central banks. There is a ledger, there's an encrypted digital ledger, but it's not blockchain technology. Better, faster, cheaper. Yeah, like if I go buy a candy bar at a newsstand at an airport, I use a credit card. The retailer now has a credit card receivable. He sells it to what's called a merchant acquirer. They bundle up a whole bunch of credit card receivables, about hundreds of millions, deliver them to MasterCard or Visa. MasterCard or Visa pays them, and then MasterCard or Visa sends the receivable to the bank that issued the card, and they send me a bill and I pay it. But think about it, one candy bar, you got 5 parties, me, the retailer, the merchant acquirer, MasterCard, and the bank. And like 2.5–3% fees and 5 steps. It's very clunky, very expensive, relatively inefficient. The central bank digital currency, you can cut out all the intermediaries. I could have an account at the Fed. Right now, you have to be a member of the Federal Reserve System, big bank basically. I could have an account at the Fed. I could have my little Samsung or iPhone, with a QR code, and I could pay you just by sending you the money, and it would show up in your Fed account, and cut out all the intermediaries. Now, I don't think they actually will cut out the intermediaries, because the job of central banks is not to help economies, it's to help banks. They don't admit that, but that's what they're there for. So they won't get rid of the banks, but this could be better, faster, cheaper, more efficient. That is true, and that's demonstrable, and these are in pilot programs all over the world. Well, this is the final step in the totalitarian surveillance state. This is the realization of the neo-fascist impulse. We see in New York, you see it in Victoria, New South Wales. It's all over the world. With the central bank digital currency, you're under constant surveillance. Now, they already know where you are from your iPhone. Turn it off. They still know. Stick it in a Faraday sack. But with the central bank digital currency, you buy a book. You're under surveillance at the point of purchase. They know what book I bought. If it's like, Why I Love Ron DeSantis, Biden might send the FBI and break down my door. The point is, they can impose negative interest rates. That's hard to do if you have a cash alternative. Along with the central bank digital currency, they're going to get rid of cash. That's already happening. You have to, because if people don't like central bank digital currencies, they can just go to cash. It's clunky, you got to hide in the backyard or whatever, but it's an alternative. So you have to get rid of cash at the same time you're pushing the central bank digital currencies. But once you do, you've got your entire citizenry under total surveillance. You can move quickly to a social credit score, which we already have in China, but welcome to communist China if you're in Sydney or Chicago. And they give a political contribution to the wrong party, buy a book with the wrong thoughts. Now, the thought police are active through computers and artificial intelligence and knowing exactly what you bought. Negative interest rates, withholding taxes. Like, hey, I work for a living, I get paid, they take out the withholding tax. They do if you're working for a wage, even if you make a lot of money, that's what happens. But what if you're a doctor, a lawyer, a consultant, a dentist, independent business owner, a writer who gets royalties, etc.? You don't have withholding taxes. You got to pay your taxes voluntarily on a periodic basis. And most people do. But now the government can say, well, we don't like that system and we don't really trust you, so we're just going to withhold it from your bank account. You can do that. Then you file your tax return, and we'll talk about it, we'll reconcile it, after the end of the year. But it's more the thought police, the surveillance, identifying political enemies, weaponizing law enforcement. The US FBI is kind of a Gestapo for the Biden administration. All that's going on already. I say things like this, people roll their eyes. That'll never happen. It's happening. Just look at the headlines. But the central bank digital currency will be the final step in this. So what will people do? People are amazingly creative and adaptive when it comes to creating new forms of money. I remember when I was a kid, there'd always be a great uncle or somebody around and say, hey kid, don't take any wooden nickels. And I was like, what's a wooden nickel? Well, during the Great Depression in the United States, we had wooden nickels. There was so little money, so much unemployment, so many business shutting down. The towns and communities created wooden money. They put a little stamp of the name of the town on it, and citizens would accept it and pass it among themselves. They were creating their own money supply to deal with the fact that there wasn't enough, it's called dollars, the regular money. So people are adaptive. So if you don't like central bank digital currencies, you should get gold and silver. A 1 ounce, we have American silver eagles. I know the Perth Mint and other sources in Australia have 1 ounce silver coins, pure silver. They're very practical. 1 ounce gold coin, it's a nice store of wealth, but that's like a couple $1,000. The ideal gold coin is a 1/4 ounce or 8 grams, which was almost exactly the weight of the British sovereign, which until 1914 was money. So as the central bank digital currency emerges, as cash is withdrawn, expect citizens to go to 1 ounce silver coins and 1/4 ounce or 8 gram gold coins, so that you can have what Bitcoin promises but doesn't deliver, which is anonymity.